Okay, we are back to do our example on page 8. So, first is the additional information. Usually it's given at the bottom, but my statement wouldn't fit properly if I did that. So, what do we know? Martinez, that's us, follows IFRS. Assume interest is treated as an operating activity for purposes of the statement of cash flows. So interest, no matter what, goes in operating activity. Operating expenses include $9,400 in depreciation expense. No disposals of equipment. Notice it didn't say anything about purchases. The common shares were issued for cash. During the year, Martinez acquired $75.20 of equipment in exchange for long-term notes payable. So, depreciation expense, which section is that going to be in? It's operating, and we're going to add it back. And if you're getting confused about any of this, go back and look at the rules on page, well, that we just went through all those pages. What goes where, and do you increase it or decrease it? There were no disposal of equipment, but maybe a purchase, so we have to check further into that. And if there is anything, which section are we going to have in? Investing. Commons were issued for cash. And during the year, and so for that, we should see the balance sheet for the number. During the year, Martin acquired the equipment. So, this would also be in investing. So, these two are related. And you have to look at you have to look at how it's with the equipment account. Now, sometimes it'll also involve the accumulated depreciation account, but sometimes it doesn't. Okay, so what I want you to do next is go to page 9. And I need you to, well, I've already done it on mine, but hit pause, and for each account, newest year will be here. I want you to see what's happened for each of these accounts. So this went from 35,720 down to 1880, so that increase of 16,920. Okay? So as you go down here, do that for each of them. Notice we're never going to use AOCI in these statements, so you don't need to do that up there or deal with it in the income statement. So just pause it and go through that. And when you're ready, come on back. Okay, so what I want us to do now is figure out, like we did for the additional, where the heck do we put these? So, where does the cash go? The beginning and the ending cash? At the bottom of the statement. And accounts receivables, which section? Well, it's a current asset, so it goes under operating, and it has gone up. So again, look at your rules. Under the operating section, should we be adding it or subtracting it? It's gone up, so we're going to subtract it because we didn't get all our sales in cash. Inventory, well, it's a current asset, so it also goes in operating, and it's gone up, so we subtract it. Prepaid expenses, they're current assets, but these ones have gone down. So current assets go in operating. And should we add or subtract it? Well, they've gone down, so we're going to add it. Notice if they're both current assets, they do opposite things. One's going to be subtracted, one's going to be added. Fair value of OCI investments. So you can calculate it, but because it's OCI, because we'll start with net income. Now equipment went up by $13,160. So somehow this is going to be in investing. See additional. Almost always, you guys, for equipment, you're going to have to see additional information. Now, accumulated depreciation went up by $9,400. You will do check with income statement information to make sure it's right. So you're going to check with the accumulated depreciation, mostly to check with the income statement information to make sure it doesn't need analysis. For example, let's say this had changed by $1,000, okay? And let's make it 10,000. But yet, when you looked on the income statement, they said amortization expense was only $4,000. All right then, so it'll help you. Okay. If amortization expense on the income statement equaled, well, let's do more than 9,400. Let's do 10,400. You look here and go, well, this only says 9,400, so there's a problem. We're out by $1,000. That would mean if this increases it, somehow we decreased it by $1,000. When would we ever decrease accumulated depreciation? We must have sold equipment with accumulation equal to 1,000. Okay, so that would be a scenario where you'd have to explore that. And again, you've done this kind of stuff in intro multiple times, so you should be able to go back and see how you got things. Okay, so those are all the assets. Now, liabilities. Accounts payable, it's a current liability. So it goes into operating, and we add it or subtract it. Add it. Sorry, it's run into each other. This 940 I'll put on the inside so you can fix it. Income tax payable, well, current liability, so it's in operating, and it went down, so we subtract it. Notice how current liabilities are different, they're exactly opposite to the current assets. Now, dividends payable went up by $4,700. So you have to assess with dividends in financing. Now, long-term notes payable went down, so that means we paid some of it off. We also know long-term notes go in financing, and I'll check additional info. Common shares went up, so what does that mean? We sold shares. That's going to be in financing. And it's going to be a source of cash. Now, retained earnings, we said we have to split two pieces. So we've got net income and dividends. So we know our net income is $14,100 from the income statement. Oh, I'm sorry, 12,220. And we don't know if we know dividends yet. So, before we can go on and actually do the statement, we've got most of our information done. Let's look at the things we need to talk about. So we said investment, see additional information for the equipment. So let's flip back to the page before, page 8. I left some room at the bottom to do some T accounts. So let's look at equipment, because we knew that was something that we'd have to check out. So equipment. And let's see the beginning balance. So looking on page 9, our beginning balance was $1,460. And we know the ending balance, $62,620. Now, what happened in the middle, just to make sure we haven't missed anything? Well, we know they acquired $75.20 of equipment in exchange for long-term payable. So we're going to have a $75.20 here, which is the note payable. And it says there were no disposals, but there may be a purchase. Well, does this plus this equal this? So go ahead, try it out. No, it's actually missing. Whenever I circle like that, we're filling in the blank. 56.40. So that's going to be a purchase for cash, since we didn't say any other way. And so that investment as a use of cash. Now, related to that was this long-term notes payable. So let's look at long-term notes payable. Now, again, look on page 9 and tell me what the beginning balance was yourself. And it's $111,860 beginning. Then we acquired equipment changed for a note, so we add the 7020 here. That's the note payable. And what did we get? What's our ending balance in the note? 78,960. And again, this plus this, does it equal that? Try it out. And no, it doesn't. We are missing 40420. And that's financing. It's a use of cash, so we made a payment. So these two things were pieces of information we were missing. And that's a matter of trying out the statement, and some things not balancing, and they're going to be different all the time. They might have given you shares, or you could be missing something else. So you really have to just do as many problems as you can to get these straight. And they're always going to change. There's literally, I don't know, tens of thousands of scenarios that they could put in. But don't just get discouraged, you guys. I've taught this course for a while. And you know, people end up getting through it. So it's just a tricky one. Okay, I will go on to the next video.